investing is about the balance of risk and return. Okay. So this is the most important thing that you know. You're balancing the two. You take less risky, you should know that you also get less return.
Yeah.
You take more risky, then you expect to get more return because you need to be compensated by the risk that you're taking. And then, of course, you come to a level based on your experience and the knowledge. Now you're trying to defy the odds by trying to take less risky and generate more return. And then, of course, for beginners, that's not what we're teaching. So for beginners, just want to balance between the risk and return. Mm. So we have the spectrum of risk and return.
Okay.
So you start with the less riskiest, which will also give you the less returns, which you call money markets. So money markets could be treasury bills from the government, could be your fixed deposit account you open with a bank. Yeah. Could be a call account, which is closely related to fixed deposit. So this is the first type of investment that is less riskier. And then next to it, I'll put mutual funds, which is pretty much a pool, as I said earlier, is reduced a lot of risk to investors, and the risk are also spread among all these investors. Then you have the bonds. You go further, and then the bonds. Now the mutual fund could be higher risky than the bond, depending on how this mutual fund is structured. I must declare that. So bonds could be less risky than mutual funds if mutual funds are structured in a way that they invest more in high risk stuff. Because the mutual funds, such as UTT, which is more diversified, they invest in bonds, they invest in stocks, they invest in shares, but the big portion of it invests in bonds, so it's less riskier. When you have mutual funds, which are what we call equities mutual funds, where they only invest in stocks. So you can have a crypto mutual fund where you take people's money and only invest in crypto. So that would definitely be, the risk will be higher than the risk of bonds. So I put bonds next to that. And again, it depends again with the bond. So within the bond, they are also declassified on their risk exposures.